You've heard the promise: a tax-free retirement without a Roth. Use the 0% capital gains bracket, pull up to $98,900 a year, pay zero federal tax. Sounds like the answer, right? And if you live in Texas, Florida, or Nevada, it might actually be. But if you live in California, New York, New Jersey, or 4 other states, that zero tax retirement comes with a tax bill of $4,000 to $14,000 a year, because your state taxes capital gains as ordinary income. That is the hidden variable that most online guides are not showing you. I used to think this strategy was airtight, until I ran the real numbers for clients living in California. The federal side looked perfect. Then we added the state line, and the whole picture changed. 1 out of every 4 American retirees lives in a state where this math breaks down. Not because the strategy is wrong in theory, because it was designed for someone in a different zip code. If you're a near retiree in a high-tax state and you want the honest numbers that nobody else is putting in front of you, hit subscribe. That's exactly what this channel is for. Let's walk through how the strategy works when it works, and then I'll show you the exact numbers on why it fails for 25% of retirees and what to use instead. First, let's give the strategy a fair hearing, because when the conditions are right, it genuinely works. For 2026, the 0% long-term capital gains bracket for a married couple filing jointly tops out at $98,900 of taxable income. That is your federal ceiling. Now stack the deductions available to a couple where both spouses are 65 or older. The standard deduction is $32,200. Each spouse also gets an additional over 65 deduction of $1,650. That is $3,300 for the 2 of them together. And for 2026 through 2028, both spouses can claim the new Senior Bonus Deduction from the One Big Beautiful Bill Act, $6,000 each, or $12,000 for the couple. Add those up and you get about $47,500 in total deductions. That pushes the real zero tax threshold to roughly $146,000 of gross income before a single dollar of federal capital gains tax applies. Here is how the mechanism flows. Ordinary income, Social Security, a pension, a small IRA withdrawal fills the deduction stack first. Whatever room is left then shelters the capital gains. And if the remaining gain falls inside that $98,900 bracket, the federal rate is 0. The order matters. Ordinary income lands first. Gains land last. Take Mark and Jean. Both are 66, living in Austin, Texas. They have a $1,200,000 taxable brokerage account, $800,000 in an IRA, and $48,000 a year in Social Security. They decide to sell $100,000 of appreciated stock. After running the full deduction stack, the federal tax on those gains is $0. Not reduced, 0. They keep every dollar. I have clients in Texas who run this strategy every single year. It is clean, it is legal, and it works exactly as advertised. The reason it works is not complicated. It is a mechanical chain. Ordinary income stays below the deduction ceiling, which keeps the capital gains inside the 0% bracket. If any part of that chain shifts, income runs too high, filing status changes, or you happen to live in the wrong state, the whole chain shifts with it. And for about 1 in 4 American retirees, that last variable is exactly the problem. That is the promise. Now here is the part that most guides leave out, the fine print that turns a $0 tax bill into something north of $10,000. Here is the part nobody puts in the thumbnail. The federal government has no income tax on long-term capital gains up to $98,900 for a married couple. That part is true. What the strategy does not mention is that the federal return and the state return are 2 separate documents, and most states have their own income tax on capital gains. In 8 states, Capital gains are not taxed at all. Florida, Texas, Nevada, Wyoming, Washington, South Dakota, Alaska, and Tennessee. If you live in any of those, the strategy works as advertised. But if you live somewhere else, a second tax bill may already be coming. California taxes capital gains as ordinary income. The top rate is 13.3%. New Jersey goes up to 10.75%. New York reaches 8.82%. Oregon sits at 9.9%. Minnesota at 9.85%. Massachusetts at 9%. Vermont at 8.75%. 7 states where the zero federal rate still produces a state tax bill that can run into the thousands. Now let's run Linda's numbers. Linda is Mark and Jean's sister. Same portfolio, same Social Security income, same $100,000 stock sale. But Linda lives in Fresno, California. The federal tax on her gain is still $0. Then the California Franchise Tax Board sends a notice. At her income level, California taxes that $100,000 at 9.3%. That is $9,300. And if her income were higher, it would push toward 13.3%, which means $13,300. When Linda called me, she said, "I thought this was tax-free. I owe $12,500. Her first reaction was embarrassment. But it was not her fault. The advice was not wrong for everyone. It was written for someone living in a different state. That is a real and meaningful difference. If you live in a state that taxes capital gains as ordinary income, you are not being careless. You are following guidance that was built around someone else's zip code. The tax code is not fair, but you can still make it work. Here is the structural reason this hurts. Unlike most deductions, you cannot write your state income tax off against your federal return under current rules. The federal side stays at zero. The state side runs separately. There is no netting between the two. About 25% of American retirees live in one of these high-rate states. 1 in 4 people following this strategy are paying $4,000 to $14,000 a year that the videos never mentioned. There are better paths. Roth conversions use the same low bracket logic on the federal side, but draw from an IRA, which does not create a capital gains event. Municipal bonds generate interest that many states exempt from tax entirely. Tax loss harvesting can offset gains on positions you need to sell anyway. But that is only the first hidden cost. There are 2 more scenarios that hit retirees when they are least prepared, and the next one can affect anyone in any state. Even in states with no capital gains tax, there are 2 scenarios that can quietly destroy this strategy. One affects people who retire before Medicare age. The other affects surviving spouses. Both are common enough that if you are not planning for them, you should be. Scenario 1, you are 62 years old, single, and spending about $50,000 a year. You are buying health insurance through the ACA marketplace. You decide to harvest $30,000 in long-term gains. The federal rate is 0, so why not? Here is why not. In 2026, the ACA subsidy cliff is back. The enhanced credits that kept premiums affordable for most people expired at the end of 2025. Now, a single person with income above about $62,600, which is 400% of the federal poverty level, loses all premium subsidies immediately, not gradually, all at once. Your $50,000 of normal income sits safely below that line, but add $30,000 in capital gains, and your total May jumps to $80,000. You have crossed the cliff. A health plan that cost you $515 a month now costs $1,244 because your subsidy evaporates. That is a $8,700 increase in annual premiums from one tax decision. The $30,000 gain you harvested at 0% federal just cost you nearly as much in lost insurance subsidies. The fix is not complicated. Before harvesting gains in a pre-65 year, Calculate your MAJY and keep it below that 400% threshold. Sometimes that means taking less from your brokerage and pulling more from cash reserves instead. Scenario 2 involves something harder to plan for. One spouse dies. Mark and Jean are filing jointly, pulling $100,000 combined from Social Security and investments, and paying zero capital gains tax. Then Jean passes away. Mark's income does not change much. The IRA RMDs keep coming. Social Security adjusts but stays substantial. But his filing status changes from married filing jointly to single. The 0% capital gains bracket for a single filer in 2026 tops out at $49,450, roughly half of what it was for the couple. The same $100,000 income that caused no tax now pushes Mark $50,000 into the 15% capital gains bracket. That is an $8,000 tax bill that did not exist the year before. I do not have a perfect solution for every one of these situations, but knowing the risk is the first step to protecting yourself. And for many couples, the answer is starting Roth conversions before one spouse passes, which shrinks the IRA balance that creates the RMD problem later. Now let's move from stress testing to what you can actually do. 3 specific levers that work for most people in most situations. So what do you actually do with all of this? There are 3 levers most people can use, depending on their situation. Lever 1. Know your state's capital gains tax rate before you harvest a single dollar. This sounds obvious, but a lot of people skip it because the federal side looks so clean. Look up your state's treatment of long-term capital gains. 8 states have no tax on them at all. If you live in one of those, the 0% federal bracket is your real rate. But if your state taxes capital gains as ordinary income, the federal 0% only tells you half the story. A rough rule of thumb: if your combined state rate on capital gains is below 5%, gain harvesting probably still makes sense most years. If it is above 5%, you need to do the math before you sell anything. And if it is above 9%, as it is in California, New Jersey, Oregon, and Minnesota, you may be better off redirecting your energy entirely. Lever 2. Set a state tax budget before you harvest. For people in high tax states who still want to harvest some gains, the goal shifts. Instead of targeting the 0% federal bracket, you target an all-in tax rate that still beats what you would pay later. Here is an example of how that math works. A couple in California pays 0% federal plus 9.3% state on their capital gains today. That hurts, but look at what happens at age 80. With a $1 million IRA, their required minimum distribution is roughly $49,500 a year, based on current IRS tables. Add Social Security, and they are likely in the 22% federal bracket plus 9.3% California. That is, over 31% combined on every dollar they have to pull from the IRA. Paying 9.3% today on capital gains to avoid 31% later on IRA income is actually a good trade. The key is running the comparison before you make the decision. Lever 3. If your IRA is much larger than your taxable brokerage, skip gain harvesting and do Roth conversions instead. This is the one that most people overlook. If you have under $100,000 in a taxable brokerage account and more than $500,000 sitting in an IRA, the gain harvesting math does not really apply to you. There are not enough gains to harvest. But there is a Roth conversion opportunity sitting right in that same low bracket window. Each year, convert enough from the IRA to fill the standard deduction, roughly $30,000 for a single filer, or about $47,000 for a couple. At current rates, that conversion may carry $0 of federal tax. Every dollar you convert reduces the future IRA balance that generates RMDs, and smaller RMDs mean more flexibility later. I used to think Roth conversions were only worth doing when you were young. Then I ran the numbers for a 63-year-old client who started converting $30,000 a year. Over 5 years, he saved $78,000 in future taxes. I was wrong about the timing. If you want to subscribe for more of this kind of analysis, where the math includes your actual situation, not just the clean version, hit subscribe. New videos come out every week. There is one more obstacle I want to name before we close this out, and it is not a tax bracket. It is a belief. A lot of people watch videos like this one and think, that is not me. They see a case study with a $1,200,000 brokerage account and feel like the whole conversation is about someone else. Maybe a little embarrassed that they do not have a taxable account that size. Maybe they click away. That reaction makes complete sense. The examples finance channels use tend to be large and tidy, and real life rarely looks like that. But the underlying strategy here is not about account size. It is about having any income you can control. Even $10,000 in a taxable brokerage account can be sold in a low-income year at a favorable rate. Even a modest IRA can support small Roth conversions that reduce the tax bill a decade from now. The logic applies at any scale. It just produces different dollar amounts. The more useful reframe is this. Stop thinking about tax-free retirement and start thinking about tax-optimized retirement. That is a smaller promise, but it is one you can actually deliver on. Each year, look at your tax return and identify one source of income you can make less taxable than it was last year. A small IRA withdrawal to use up the standard deduction. A few shares sold at a gain when your income is lower. One move per year compounds over time. I will be honest. I have clients sitting on $2 million in IRAs who still feel behind. The anxiety about not having done enough is not a function of account size. You are normal. The guilt about not having a bigger taxable account, let it go. We work with what is actually in front of us. That mindset shift is worth more than any tax bracket. Now let's bring this home. Let me bring this together. The 0% federal capital gains bracket is real. For a married couple in a no-tax state, it can produce a genuinely tax-free retirement income. That is not marketing, the math holds. But the strategy comes with 4 variables that can change the result completely. Your state's capital gains tax rate, your ACA eligibility before age 65, your filing status if one spouse passes first, and the size of your IRA relative to your taxable accounts. If you are IRA heavy, Roth conversions give you the same low bracket opportunity without the state capital gains exposure. If you are pre-65, keep an eye on MAJ and the ACA subsidy cliff at $62,600 for a single person. If you are in a couple, plan the widowhood scenario now, not after. Wes Investor exists because the tax code is complicated, and the guidance you find online is usually only half the story. My job is to give you the full picture, including the parts that complicate the simple narrative. No hype, no hidden agenda, just numbers you can trust and work with. If that kind of honest analysis is what you are looking for, hit subscribe. I put out a new reality check every week. And remember, the difference between a $0 tax bill and a $14,000 tax bill is often just one variable: your state. Do not let anyone tell you the simple version works without checking that box first.